I made a market simulation to see if patterns are real. All right, Crafer, this sounds interesting. Let's dig in.
Have you ever wanted an answer to a problem, but no one can agree on anything? Alright, here's the problem. There are fake gurus out there who will sell you on secrets to making money that don't actually work. Worse yet, these gurus are proven liars who make their money from lying to beginner traders who don't know anything. Oh no! On the other hand, there are YouTubers who call out fake gurus, claiming that patterns aren't real and it's just a weird psychology thing with how people buy and sell, and it's the male equivalent of astrology. So the
I guess I'll let him cook. Let's let him cook before I comment.
question still stands, is it real or not? Well, if we really want to put this to the test, we'll have to do it ourselves and build an entire market simulation from scratch.
I mean, already the first problem with this is that a lot of the market patterns become self-fulfilling because so many traders are taught to look for them. They're so popular. They're so easy that then they just become self-fulfilling. Now, if you're a new trader and you want to know when these patterns are likely to occur, or even just understand that when you are a trader, you are operating in a world of probabilities. So you need to understand that each of these have various probabilities, and you need to learn the techniques to increase the probability that what you're seeing on a chart could actually play out, right? And also keep in mind that, those probabilities on certain time frames. So if you see a structure in a daily, it's going to be more significant than if you see it on a 1 minute chart. And, a hint that I'll give you is, there's more on my course. I just don't want to talk about it for freaking, 10 minutes and give the full breakdown. But a simple thing you can do to immediately increase your probability significantly on whether you're playing into or a pattern that will likely play out is, one, actually wait for it to play out and don't play the prediction game and just react to it. You won't make as much as if you are predicting. But two is to actually just use something like relative volume and see, are more participants pouring into this structure and looking for it to play out. And that will increase your probabilities when you're looking for like market structures. We'll see how this simulation goes, but already there's kind of a red flag there because this stuff doesn't really work when you eliminate humans, because humans, obviously, when you deal with money, there's a massive psychology there. People will say there's no psychology on the chart. There's still psychology here, always, that you have to fight. So we'll see how this goes. It's already pretty interesting.
In a market, there are people who want to sell a product and people who want to buy it. If we throw a whole bunch of these people into a simulation, it'll create a little microcosm market. But right away, we run into a problem. How do these people make up prices? One person could make up $100 and another, say, $2. There's no rhyme or reason to this. To fix this, we'll use one piece of human psychology, and then the rest of the video
I'm going to speed this up, guys. We're going to watch this in 1.25 at least.
promise will be math focused. We're trying to make this as unbiased as possible, but we need this detail here. So if the price is $100, the new prices that traders pick will be up or down 1% at a random value. So if someone heard hot dogs are going for $5 a piece, it's pretty unlikely they'll suggest $50 as the next offer. So our code makes the price like $4.95, the likely next offer. All right, with 1,000 of these traders in our simulation, it just kind of sits there. So there's something called a maker.
So we didn't feed this to people. This is like a code. This is like he's plugging this in, like a Visual Studio, I guess. I guess that's what I'm assuming. So when he says people, it doesn't mean actual people.
And they make the order in the order book, and then a taker who takes the order at whatever price is there. And if everyone is happy with the current price,
that's not how markets work. This isn't. It's 10 minutes long, so I guess he figures out that this isn't going to work, but
prices, nothing's
let's let him cook.
going to change. They just keep placing the same orders over and over again. And it looks like if nothing is happening, then maybe we do need psychology after all. Let's just give it a shot real quick, but I started coding up some new traders with different strategies. So we got random traders, but then we have trend followers who buy when it's going up and sell when it's going down. Something called high frequency traders. They place buy orders below the price, sell orders above, and then whales who place these huge orders. Let's give it another shot, but even with all this psychology, it looks like it's impossible to get any long-term patterns to form. I honestly messed with this for a long time, but it just doesn't really resemble a market. So I think if we want to have any hope of proving whether patterns are real or not, we're gonna have to try a different approach. So since we're trying to stay away from psychology, let's focus on these random
This is literally in
triggers.
Visual Studio. I see what he's doing. This is cool. This is a cool project.
Prove that patterns are math-based, not psychology-based. So if we can prove that patterns show up even when the traders are completely random, then we've actually proven there's no psychology needed whatsoever. But the longer I ran each simulation, the more this kind of stagnating process.
I mean, there's no way you can prove there's no psychology whatsoever. I mean, that's just nonsensical. Of course there is. I mean, that doesn't even really need to be proven, right? It's self-evident. You're handling money. Of course there's psychology because there's literally millions and millions of participants within the market and they don't all act logically. I mean, just in life, just think about how people handle the personal finance and the decision making that goes into it. It's not just all logical. So it's not any different in the market. Anyways, let's continue.
Problem would happen. Maybe the price would move a little bit up or down.
I just don't know why people would even struggle with that concept because it's so self-evident from, I mean, it's just, I don't know, it's just simple critical thinking. I don't know.
But then it would just stop. Eventually, it would be kind of trapped in this like 1% range, which makes sense. The random traders only place orders plus or minus 1%. And so the 1% just stays the same no matter how long it goes. It's almost as if these huge walls on either side of the price kind of keep it from moving. And every once in a while when those walls were gone, we would see these huge price movements. But how do we get that? What we need is to remove the walls. So in my code, I've had a 50-50 chance where an order is either a maker, where it just sits there, or a taker, where it takes the available offer. I figured at this point, maybe there's too many makers, which is creating the wall. So I got rid of a few, and I didn't really expect much to change. But the price began to move, like a lot. And now it's making these huge jumps between existing orders. So let's try 0 market makers at all. And I barely changed anything to the code, but this tiny change completely altered the simulation. Here, look at this. All of these random orders seem to be slowly moving upward, even though it should be random. And like, remember, our traders are random. There shouldn't be any patterns here. So this is a real pattern in real markets, and it's called support and resistance. And our simulation is
This is a good video so far. It's fun. There's just like so many issues that I don't even know what I should like comment on. Because obviously this is not simulating a real market whatsoever. You don't have any news events, any catalysts, you don't have like an underlying with significant value that can then establish a baseline or metrics for proper evaluation that traders are trading off of. There's like so many infinite variables that make this exercise completely useless, but I mean, obviously this is just an uptrend. These are trend lines, and you could say there is resistance up here and support up here, but this structure isn't. It's just 2 trend lines.
Real pattern in real.
I get what he's saying, but it's just goofy when someone says that this is called support and resistance.
Markets, and it's called support and resistance. And our simulation is recreating it through pure mathematics. Okay, let's run through some tests to see if these resistance lines show up more. All right, I'm checking it out, but it's not what I was expecting. Let me draw this real quick. So this sort of looks like nonsense, but if I bring over this, it looks like one of those trading diagrams. So I've actually found a bunch of these, and they literally play out according to the rules. In the real world, markets are driven by an order book. It keeps track of all of the available maker offers.
You don't need to do a simulation, right? You can literally just pull up a historical graph of the market and see these all over the place. Like, this seems so pointless. You could just pull up a fucking stock chart, bro.
And that's really what we've coded into our simulation. But I'm curious what kind of an impact this order book has on the price. For instance, do the tops of charts have a huge order that's preventing the price from moving up? The only way to figure this out is to visualize the order book history. So we'll draw out each one of these order bars, and then we can make them more or less transparent based on the size of the order. Now, I have to rewrite my entire simulation so it runs on the GPU, but ever since I figured out how to do this, this is actually super easy, and honestly, you can run anything on the GPU. In Unity, the shader scripts end up using the GPU, so everything is just a shader. I've even written a neural network inside of a shader, and this was because I was trying to see if you could train an AI to make trades to make money, and that turned into a whole side project. But for now, we're still trying to figure out why exactly these patterns seem to show up. Okay, take a look at this. This is sort of a weird U shape, but others would call this a cup and handle pattern. And everything about it, from the cup shape to the small handle, it all shows up right here. It's beyond fascinating that the patterns show up at all, let alone they're the same patterns that appear.
Yeah, remember the best cup and handles have this flag pattern for the handle. So if you look for that and you see that flag pattern, it starts to break through, that's when you enter.
In traditional markets. But my biggest question is still, why? The inescapable prevalence of a phenomenon such as patterns kept sprouting up like a weed. It was like a rock that I just couldn't quite shake out of my shoe. But then it hit me. Since we've already ruled out psychology as an explanation, because we're only using random traders, then there must be a mathematical explanation for all this. An explanation that had to be simple. Consider this chart. Now, technically, none of these traders care about what the price used to be. They place orders purely based on the current price. And at $100, they'll place a ton of orders around 100. Now let's just say that price goes up to 120 briefly. The next time the market wants to move down to 100, there are all these new orders it would have to get through. Well, maybe it only hits 101 or 102 and it doesn't go below that. Well, the traders keep placing new orders around 102 because that's what they do, and a new slew of prices flood in. The next time price returns to this area, it has to get through 102. Well, this can happen over and over again. And over time, it can appear as if there is resistance. You get, say, 3 of these dips together and you can practically draw any sort of line through them. So technically, resistance lines are a total mathematical principle. But
right. And you teach it just as a pattern, because that's the definition of mastery is taking this complex understanding and boiling it, boiling it down to the simplest framing possible for your execution. The simpler your trading strategy is, the more likely you are to be profitable, right? Now, trading these patterns is difficult because they don't always appear on all stocks, and they rarely appear on something like an index. So you got to expand outside of that. But it's a great intro for people.
more importantly, since patterns show up in our simulation, this means that patterns are really just extended support and resistance. You take all of these patterns and really you can extend everything, and it's just these different support and resistance lines. So in a weird way, we've proven that patterns are actually real? Now, I'll be totally honest, when I set out making this simulation and this video, I did not expect this result. I genuinely thought that we were going to find out that patterns are fake, and I was trying everything I could to make it not work. I tried introducing psychology and doing anything to show that the random trading would not create patterns. But nope, I just basically proved that in real life, the markets are driven by people who are just as erratic and unpredictable as a random number generator. In essence, most people have no strategy, no reasoning, and you perform just as well by randomly buying and selling, which solidifies that the reason patterns show up at all is based purely on...
How the fuck is that your conclusion? Your conclusion is that it's all random, that the market is a random walk, but you just identify the patterns that, okay. This is what, way to cook your bias into that conclusion, brother.
How the order book fills up over time, not based on human psychology and people trying to predict the stock market. I mean, think about that. The fact that we can generate patterns that look identical to the stock market with random nonsense.
This is what, but you have to understand, like most participants in the market are not traders. Most participants in the market are passive, right? They're passive actors who are not actively trading the market, and they're trading off long-term theses, right? And then you have other non-discretionary participants that are executing off of algorithms that are doing the math-based execution that you're talking about as well. So yeah, everyone is betting that things will go up generally, but there are these high frequency non-discretionary participants that are in the market. So you get these patterns.
trading means that most stock market traders are kind of bad at trading, which makes sense. There wouldn't be any money to be made if everyone was good at it, but I still find it so comical.
There would still be money to be made in a market if everyone was good at it. I mean, good at investing at least. Everyone can win if a stock goes up, right? Especially if you're doing controlled selling. Some people need to sell at different time frames for different reasons, and the more participants come in when you get the dips, and then they get to appreciate their positions.
Cool. So
until they retire, and then the next participant pool comes in and they buy it, it goes up more. Everyone can be a winner in investing. There doesn't have to be losers.
Anyway, I guess that this means now we'll have to make an AI learn how to trade the stock market using patterns or something. I don't know. If you want to mess around with this simulation, it's on my Patreon. The project has some buy and sell buttons that I've added so you can try to make money or lose money or, do whatever with it. Oh yeah, I have a Patreon now. A special thanks to all these patrons who have already signed up. Thank you all so much. We also have a Discord, so join the Discord. I haven't even talked about it before, but quite a few of you have already joined. So come on over and hang out. We'll do some game jams at some point, work on projects together, and just send some good old memes back and forth. All my video projects are on my Patreon, I think. I'm trying not to just dump the whole project onto GitHub, mainly because I'd rather make a gamified version of each video instead of making you build it yourself. And later on down the road, maybe I'll turn the Fluid Sim game into an app or something. I don't know. You don't know. We don't know. No one knows. So stay tuned because you might miss it. I'll probably miss it. Oh no, it's that tune again. I guess we're out of time. Bye.
That was a fun little video. There's literally no reason to code that, because you can literally just go to any previous stock chart, and it's pretty self-fulfilling that patterns exist for a multitude of reasons. And that's kind of the issue when there's a lot of these videos where guys who they don't learn even the bare minimum of how the market functions, or just in general. There's so much you got to know to understand why these things work or why they don't work. And then they try to make these videos and act like, I can spot the fake gurus within 30 seconds. I can tell who's legit, who's not. I've been doing this for so freaking long. It's just so obvious, right? It's nearly instantaneous. But these guys, they don't. So everything's just kind of like a mystery to them of what's going on or what means what. And it makes these videos a little bit wonky. Despite that, it was a great video. Cool guy. Check out his channel. That was entertaining. Follow me for more reactions.